Unfortunately, I don't speak any French, so you will have to suffer through this presentation in English. Thank you very much for the invitation. Thank you for the kind introduction. It's an honor to be here, especially in this forum, especially in this setting, as Konstantina mentioned. Here is the birthplace of the emerging market concept 40 years ago. Now we come back, we want to talk a bit about emerging markets. So my topic is, as you said, what do we mean when we talk about emerging markets? And what are we really saying? As you mentioned, we look at a group of the 40 largest emerging market economies. We cover these on a monthly, quarterly, and a yearly basis. And I would like to talk about what I call the two emerging worlds, right? Here's what I mean. So what we've done for this presentation is to divide the largest 40 emerging markets into two groups. One of them we label Group 1, and one of them we label Group 2. I'm not going to tell you yet who goes into Group 1 or Group 2, but I want to discuss now some of the differing characteristics of each of these groups. So the blue line here is real GDP growth for the last 25 years in EM Group 1 vis-a-vis the developed universe, which is in yellow, right? And if you look at this line, you notice two things, right? Number one, obviously the emerging group has grown faster on average than their developed counterparts. This is what we normally find in developing economies. But if you look at the pattern of growth, very, very similar, right? You had a brief period in 1997-98 when there was a very specific emerging market collapse. Other than that, the two lines move up together, they move down together, they move up together, they move down together, right? So you're getting a very similar growth profile between this emerging group and the developed group. Now we look at Group 2. This is the other emerging group, the other half of the economies we follow. This is very different, right? You get a massive collapse in 1997. You get a huge outperformance in the 2000s. You underperform, you go up again, you come down again. The last 3-4 years have been disastrous. So much greater volatility, right? You're not simply following around the developed world. You actually have a lot of idiosyncratic, very specific moves that are specific to this group, right? If we look at equity returns, so here I'm turning now from growth to look at market performance. And this is the market-weighted average stock performance in dollar terms. Again, in blue you have EM Group 1, and in yellow you have DM ex-US. So this is Europe, Japan, and the rest of the developed universe. And if you look at the two groups, again, very, very similar. For the last 7 years, you've had no outperformance whatsoever in EM. You've had a bit of ups and downs in the 2000s, but really, if you go back 25 years, you are still exactly in line. I mean, this asset class has not given you any excess return really over the last 25, nearly 30 years, right? Very, very similar performance. If you go to Group 2, completely different, right? You start very low, you explode upwards in the mid-2000s, you stay in line for a while, you've exploded downwards again in the last few years. Again, very differentiated, much bigger outperformance initially, bigger underperformance. So again, very volatile, much less correlation with what's going on in the developed universe. If you look at currency performance, so here we're looking at currencies against the US dollar. EM Group 1 is in blue, and the non-US G10, so everyone else outside of the US in the developed world, so we're looking at their currency performance against the dollar. Once again, I mean, EM Group 1 looks almost exactly like its developed counterparts, right? There's been very little out or underperformance. The last decade in particular is virtually lockstep. So again, it's just not much to talk about here. Whereas Group 2, again, massive devaluation in the 90s. You stay around for a while, massive devaluation more recently. So again, there's much more going on in terms of idiosyncratic moves. Finally, if I look at interest rates, another part of the market portfolio, the same thing. Again, yellow is developed. Group 1 is in blue. So, you have about 2 percentage points of gap in terms of interest rates, but interest rates that move in exactly the same way. It isn't until you get to group 2, which I've shown in red, where you find that rates are much, much higher. They go up, they go down, they go up, they go down in a much more uncorrelated manner, right? So again, here we have two groups, one that tends to follow developed markets very, very closely, and one that tends to move around a lot on its own, right? So what are we saying? Well, what we're saying is that, in fact, there's almost no reason to invest in emerging group 1, right? Why would you invest in this group as a whole? You're getting the same returns in the developed market world, the same growth profile, the same currency performance. The only difference is, of course, is that the developed world offers you much better access and much better liquidity, right? So again, for the last 25 years, there's really been very little reason to be invested in this group. By contrast, if you sit with EM Group 2, you make a lot of money, and then you lose a lot of money, and then you make a lot of money, and then you lose a lot of money. But during good periods, of course, you have huge outperformance. During bad periods, disastrous performance. But Group 2 is the uncorrelated asset, right? Very high beta, very idiosyncratic moves. If you think about this from a portfolio construction perspective, the only group in this that is giving you uncorrelated alpha, if you will, is Group 2. That's the asset class that you want in your portfolio, especially if you're very good at timing during periods of ups and downs, right? But this is the one which goes in when you think about a classic portfolio construction, right? Now let me broaden. I've talked about the last 25 years. Let's go back to 1970. So we'll talk about the last 55 years, right? Same thing. EM Group 1 has its ups and downs, but actually is a fairly stable growth profile, right? Whereas Group 2, I mean, is collapsing, is coming back, is collapsing, coming back. It's not just the last 20 years. They've been doing this forever, right? They go up and down a lot, right? If we look at inflation, yes, I mean, you get some high inflation periods in Group 1, but Group 1 is fairly well behaved. Group 2 explodes in hyperinflation, then comes back down again. Again, lots more volatility and beta going on. Public debt ratios for those who invest in debt as an asset class. Group 1, very stable, up around 40%, 45% debt to GDP, whereas again, Group 2 goes careening up, comes down, goes careening up and coming down. So again, it's not just the last 20 years. These groups have very different innate characteristics from as long as we've been watching emerging markets, right? So now is the time where I want to open up who are in these groups, right? Group 1 are manufacturing economies, right? Group 1 are China, North Asia, most of Southeast Asia, so Thailand, Malaysia, Philippines. We have Singapore and Hong Kong in there. We have Central Europe, virtually the entire Central European region. We have Mexico, we have India, we have Turkey. What do all of these countries have in common? All of these countries have a manufacturing share in their exports of more than 50%. So they are industrial manufacturing exporters. They're not part of the commodity bloc. By contrast, Group 2 is the commodity exporting bloc, right? This is Argentina, Brazil, Russia, South Africa, Indonesia, and basically everyone else. You've got the rest of Latin America, you've got the CIS, you've got all of the Middle East, right? And you've got Africa, right? So what we're saying here is that, again, when you look at emerging markets, the countries that everyone likes, which are, of course, the higher growth, more stable, industrializing players, are actually the countries that are not giving you an interesting return profile, right? Of course, individual countries do. Thailand can have 3 great years, right? China and India can be on a run for 18 months, 24 months in terms of their markets. But when you look at this as an aggregate class, right? If you look at manufacturing economies that are industrialized or industrializing, they tend to be driven by exactly the same cyclical factors that drive developed countries. They're all in the same industrial trade-driven group, if you will. They have very similar return characteristics and very similar profiles in aggregate. The people who are giving you all the interesting stuff are the commodity players because, of course, they're driven by something very different. They rise and fall when commodity prices go up and down, right? So there you're investing in the commodity cycle, but again, this is a relatively uncorrelated class with what you're getting out in the developed and the industrial emerging world. So you're facing a choice here between lower return, low beta industrialized markets and very high beta markets driven by idiosyncratic swings in commodity prices. And once again, it's the latter markets where you tend to make truly less correlated, higher volatility and more independent returns. So that's one key finding that we always find when we look at emerging markets. The other direct corollary to this is that you do not make money by holding emerging markets structurally as an asset class, right? Because think about it. If you're buying the stronger balance sheet, better, more stable, predictable industrial players, you make the same return as you do everywhere else, right? So there's not necessarily a reason to have them in. But when you buy the high volatility commodity players, of course, you do very well for 5 years. And then you collapse for 5 years. And then you do very well again for 5 years. And then you collapse again for 5 years. This is not an asset class that you want to hold structurally. This is an asset class that you want to play very, very tactically. And so it has been in emerging markets for the past 25 to 30 years. You've been much better off buying at the bottom when commodity prices are coming online, when the global economy is starting to grow. You lever that trade up, you make money like mad for 5, 6 years in a row, and then you need to make your exit before everything falls apart again, right? And then you want to stay away for the next 5 years and buy in at the bottom of the next commodity cycle. I bring this up, of course, because today we've had 4 or 5 years of falling commodity prices. Now we've seen a year where commodity prices have bounced back up. We've seen suddenly outperforming returns again. The biggest question in emerging markets today is, are we at the beginning of a new commodity-driven rebound, in which case you want to be in EM. And when you want to be in EM, you don't want to be buying Thailand and India and Singapore and the Central Europeans. You want to buy Russia and Brazil and Argentina and Indonesia. I mean, yes, they just collapsed on you. They lost 80% of their value in the last 5 years, but these are the ones that gain all of the beta when you're buying on the upside again, right? As it has been in the last year. The best performing markets in EM have been the high beta commodity recovery plays. And this is one of the big questions you have now when you look at where emerging markets are going from here. So this is an important point. It's something that we've seen decades and decades as we sit and look at emerging markets. This is a rule that has gone back 30 years in time. It remains the case today. So yes, this is an important thing that we want to stress. I want to turn briefly now and talk about something very, very different. So that is the first main issue on emerging markets that I'd like to discuss. The second has very little to do with market investing and more to do with the question of who becomes a superstar and who becomes a breakout economy in the emerging universe. This is a complicated chart, so let me explain this very briefly. On the bottom, I have per capita GDP relative to US GDP in 1960. That's the horizontal axis, right? In the vertical axis, I have per capita PPP as a share of the US level. So this is relative standing in the world. 55 years later in 2015, right? And I've put all 180 plus emerging market economies as covered by the World Bank into this chart, right? This chart is extraordinarily interesting. And the reason it's extraordinarily interesting is that virtually every country sits on the 45-degree axis, right? What are we saying? Of the 180 emerging market developing countries in our global database, 150 of them failed to improve their standing meaningfully over 55 years. Their relative income gaps today are the same as they were in 1960, okay? We always talk about the middle income trap, which is that you grow fast for a while and then you reach a certain level and then you kind of get bogged down and slow. What this chart is telling us is something very different. There is no middle income trap. There's simply a trap, right? Most developing countries are simply stuck. Over 50 years, over 60 years, they have not done anything to improve their standards. The only countries that have given you meaningful improvements in a relative basis are this group up here in red and in green, right? Who are the countries in red? Well, we have the 4 Asian tigers, Taiwan, Singapore, Hong Kong, and who am I leaving out? Taiwan, Korea, thank you. We have China, who has done amazing things in the last 30 years. And then we have a few Middle Eastern countries. We have Qatar, we have Oman, and we have Botswana and Equatorial Guinea in Africa, right? Very strange. And then we have the green, and the green are basically, I haven't labeled them, but they're Southeast Asia. So you have Thailand, Malaysia, you have, to some extent, Indonesia, Philippines, and you have the rest of the Middle East. So you have Saudi, you have Bahrain, you have the Emirates, right? These are the only ones out of the entire 180 countries we follow that managed to do something interesting and meaningful and break out of this mold over the past 55 years. How did they do it? Well, here's another chart, right? So here on the vertical axis is the average growth rate over the last 45 years. And here on the horizontal axis is the average export growth rate, right? And you know, this is a bit of a hodgepodge in terms of the chart, but you can see where all of the breakout countries are, right? They're all at the very top. And the message here is very simple. You become a world-beating growth player by becoming a world-beating exporter. This is what the Asian tigers did. This is what China did. This is what Southeast Asia did. And this is what Botswana and Equatorial Guinea and the Gulf states did. Now, if you're Botswana and Equatorial Guinea or the Gulf states, how did you manage to do this? Well, the answer is very simple. You have tiny populations, 1 million people, 2 million people, and you discover oil, or you discover diamonds, or you discover something else. Again, if you have 1 million in your population, you can grow just by finding resources in the ground. But if you have 50 million or 100 million people in your economy, there's really only one way to do it, and that's been manufacturing exports, right? The Asian economies jumped on the manufacturing bandwagon, and this is how they grew for 20, 30, 40 years in a row. And this is very hard to do, right? The reason, of course, that we only have a handful of countries who have managed to do it is that the secret about manufacturing is how geographically concentrated this activity is. This is a heat map. From 1995 through the present, what I've done is show the economies who have managed to raise their manufacturing export GDP share by meaningfully more than 15, 20, 25 percentage points, right? So really, truly increase their standing in terms of manufacturing export penetration. There are only 2 parts of the world. Since 1990, 1995, there are only 2 small parts of the world who have managed to do this. One is concentrated in Asia. This is China, this is Southeast Asia, this is Vietnam, etc. And the other is Central Europe, who, after the breakup of the Soviet bloc, took a massive amount of investment and offshoring from Western Europe and managed to grow. That's it. If you're out in Africa, nobody, right? There's not a single country in Africa that managed to show meaningful manufacturing export-led growth. There's not a single country in South America. Even Mexico on the border with the US, for all the talk about NAFTA, was only a marginal player. Why is this the case? Well, this is the case because manufacturing activity generally sits on the borders of continental Europe, or it sits in the Asian trade zones. And as one country finishes, they pass it to the next in line. So first you had Japan, who in the post-war era jumped and developed 20 years through manufacturing-led growth. They passed it on to the 4 Asian tigers. They passed it on to Southeast Asia, and then when China came online, they basically cannibalized all the market share. It's very difficult, right? I don't care how competitive you are in Africa, on the West Coast, on the East Coast. I don't care how hard you work at improving your business climate. You have a very low chance of success because all of the manufacturing activity is sitting on the Asian trade routes, right? And when it comes time to pass the mantle on to the next economies in line, it happens along very similar geography. So let me give you an example. I'll skip a couple of slides. This is China, right? Just over the last sort of 20 years. And I want to call your attention to the blue line, which is Chinese global market share in light manufacturing. So these are toys and shoes and sporting goods and furniture and apparel, right? Low-end, labor-intensive activities. Of course, China, for all the 90s and into the 2000s, rapidly increases its market share. And then, magically, since 2007, is now losing market share. China is shutting down its factories in footwear, in T-shirts, in tennis rackets, in household plastic goods, right? This is all moving out of China, right? Its market share has been falling. Why is Chinese market share falling? Well, because China's been very successful. Its wages have gone up hundreds and hundreds of % in dollar terms, right? At the beginning of the 2000s, a Chinese laborer in the factories was making $70, $80 a month. Today, that labor, semi-skilled, low-end activity is making more than $500 a month in a basic, unskilled job, right? So, of course, Chinese market share gains are over. Here's the question. Where is that capacity going, right? Again, for the first time in a generation, China is giving up its low-end industries, giving up its market share. Who is gaining? Only one small concentrated group, right? If I look at all of the candidates who have low wages and competitiveness, I look at North Africa, I look at ASEAN, I look at India, Central America, we've got the CE periphery. In fact, there's only one group who has meaningfully managed to increase its manufacturing export exposure and explosively increase its exposure over the last 8-9 years. This is the blue line, and the blue line is 3 countries, Vietnam, Cambodia, and Bangladesh, right? This is where all the investment is going. This is where all the capacity is moving. And really, there are only three countries in the world who are getting it today. Indonesia, sitting south of China with 250 million people in a large, low-end, relatively competitive sector, not happening. India, the world's largest share and largest stock of cheap labor, waiting to move into the industrialized manufacturing sector, not happening, right? It's happening right next door to China, on its borders in countries that are sitting on the same trade lanes, have some established ties to the same logistics people. And this is the dirty little secret of growth and development, right? China was a miracle economy for 20 years, right? China is now, graduating from that miracle, if you will, in terms of low-end exports. It's passing on its capacity, and it's passing it on to a small, concentrated group of people who are the next miracle countries. For the next 10 years, watch Vietnam, watch Cambodia, and watch Bangladesh, right? Bangladesh today is the crappiest, poorest, worst governed economy in the Indian subcontinent. Everybody talks about India, everybody talks about Pakistan. But you watch, in 10 years, Bangladesh will be the wealthiest, best governed, and most dynamic country in the Indian subcontinent because, again, it's the one that's getting all of the Chinese manufacturing investment that's leaving. And that's it. That's what I want to say. So again, just to summarize, 2 key points. Number 1, when you think about emerging markets, it's best not to think about emerging markets, right? Very, very different characteristics if you look at industrialized, stable growth players vis-a-vis the highly volatile, highly beta, commodity-oriented players. And it's the latter group that's actually more interesting from a portfolio construction perspective. That's point number one. And point number two, when we think about true miracle working in the emerging world and how you generate a true breakout economy, who are going to be the next absolute massive growth stars? Again, this is still happening within the Asian borders. It's still happening in a small, concentrated group of players who are now the successors to the Chinese miracle over the last 20 years. I'm leaving lots of time on the table, which is good, because I will pass the mantle on to my successors. But I wanted to say thank you very much for the opportunity, and good luck in today's conference. Thank you.
Thank you, Jonathan.